Let me show you something worth noticing. There's a specific kind of restlessness that shows up around money, and most people mistake it for ambition. It feels like vigilance, like you're staying on top of things. You check your portfolio in the morning, again at lunch, maybe once more before bed. You read the headlines. You compare your returns to the index, to your friends, to what you think you should be doing. And underneath all of it is a quiet hum of anxiety that sounds like responsibility but functions like something else entirely. The strange part is that this behavior doesn't correlate with better outcomes. In fact, the data suggests the opposite. The more frequently someone checks their investments, the more likely they are to make changes. And the more changes they make, the worse they tend to perform over time. It's not because they lack information. It's because the act of watching creates the illusion that watching matters, that your attention is somehow participatory, that wealth is built through monitoring rather than through time. I knew someone years ago who managed a small portfolio with the intensity of a day trader, even though he wasn't trading daily. He wasn't reckless. He was careful, thoughtful. He read constantly. But his relationship with his money had this twitchy quality to it, like he was always waiting for the moment when his attention would be rewarded, when the spreadsheet would light up and say, "Yes, you were right to keep checking." And that moment kept not arriving, not because his investments were bad, but because growth doesn't announce itself. It accumulates in silence, in increments too small to feel like progress on any given Tuesday. What he didn't realize, and what most people don't realize, is that the emotional need to check is not a need for information. It's a need for reassurance. And reassurance is not a strategy. It's a symptom. The mind interprets stillness as negligence. It interprets not doing as risk. So it creates tasks. It generates reasons to look, to adjust, to feel involved, and in doing so, it mistakes motion for progress and presence for control. Here's what actually happens when you stop watching. Nothing dramatic. You don't suddenly get rich. You don't unlock some secret. But you do remove one very specific source of interference. You stop reacting to variance as if it were signal. You stop interpreting short-term noise as long-term information. And without that interference, the underlying system, the compounding, the boring, mechanical accumulation of value, it just continues, uninterrupted. Not because you're ignoring it, because you're not disrupting it. There's a study that tracked the performance of various investor groups over a decade. Active retail investors, professional fund managers, and then a third group, people who had opened accounts and essentially forgotten about them. Maybe they moved, maybe they lost interest, maybe they died, and the account sat in probate. The forgotten accounts outperformed both of the active groups, not by a small margin, by enough that it should make anyone uncomfortable, because it suggests that the variable dragging down returns wasn't market conditions or stock selection. It was human presence. The act of managing became the problem. Now, this doesn't mean neglect is a strategy. It means that the emotional texture of attention, the need to do something, to feel like you're earning your outcome, that impulse is expensive, and most people never calculate the cost because it doesn't show up as a fee. It shows up as a series of small decisions that feel justified in the moment, selling after a drop because it might drop further, buying after a rally because you don't want to miss it, shifting allocations because something feels off. Each move defensible on its own. Each move quietly corrosive over time. The hardest part isn't the waiting. It's the lack of feedback. Wealth that grows slowly doesn't feel like it's growing at all. You check the balance and it looks almost the same as last month. Maybe a little higher, maybe a little lower. Nothing that suggests significance. And so the mind starts searching for something more responsive, something that reacts to your presence. Day trading, options, crypto, real estate flips, anything that gives you the sensation of influence, of cause and effect, of being the reason something happened. And that sensation, that feeling of agency, it's one of the most expensive feelings you can buy. I think about this whenever I hear someone say they're being disciplined with their money, because often what they mean is they're watching it closely, they're monitoring, they're involved, and in their mind, that involvement is discipline. But sometimes discipline looks like the opposite. It looks like setting something in motion and then walking away, like planting a tree and not checking every week to see if it's taller. The growth happens whether you watch or not. Your attention doesn't water it. There's a psychological term for this, though it's not used much in finance. It's called process substitution. When the mind replaces a goal with a proxy activity that feels related but isn't actually productive. Checking your portfolio feels like wealth building. It has the texture of financial responsibility, but it's not the same as contributing regularly, minimizing taxes, keeping costs low, staying diversified. Those things are boring. They don't provide feedback, so the mind drifts toward activities that do. And slowly, without noticing, you start optimizing for the feeling of participation rather than the outcome. What's interesting is that the people who do best with money long term often describe a kind of emotional distance from it. Not detachment, not carelessness, but a lack of urgency around daily fluctuations. They set up systems. They automate. They check in once a quarter, maybe less. And when you ask them why, they don't frame it as strategy. They frame it as temperament, as not wanting to think about it, as having other things to focus on. And that casual indifference, that lack of emotional investment in the minute-to-minute, it turns out to be one of the most valuable traits you can have. Because here's the thing nobody says out loud. Wealth grows in the gaps, in the periods where you're not deciding anything, where you're not reacting, where the compounding is just running in the background, unnoticed, like interest accruing overnight. The moments that feel like nothing, those are often the moments when everything important is happening. And if you're too busy watching, if you're too busy managing the feeling of watching, you end up interrupting the very process you're trying to benefit from. This doesn't mean you set it and forget it forever. It means you separate the activities that matter from the activities that feel like they matter. Rebalancing once a year matters. Tax loss harvesting matters. Making sure your asset allocation still fits your timeline, that matters. But checking your balance daily, reading every market commentary, refreshing the charts, those don't matter. They just feel like they do. And that feeling, that sense of being plugged in, it's not free. It costs you in decisions you wouldn't have made otherwise, in energy spent on things that don't move the needle, in a relationship with money that's more anxious than it needs to be. I don't think most people realize how much of their financial life is theater. Performance for an audience of one. You check because you think you should. You adjust because doing nothing feels irresponsible. You stay informed because the alternative sounds like negligence. But none of that is actually required. The wealth grows or it doesn't. Your attention doesn't change the trajectory. It just changes how it feels. And if you're not careful, you optimize for the feeling and sacrifice the result. The people who build wealth quietly, the ones you don't hear about, they tend to share this trait. They're not more disciplined. They're not smarter. They're just less emotionally involved in the process. They set it up, they let it run, and they go live their lives. And 20 years later, they wake up and realize the thing they weren't watching became the thing that mattered most. Not because they were patient, because they were absent. And absence, in this one specific context, turned out to be the highest form of discipline. Thanks for watching. Subscribe and turn on notifications so you don't miss what's next.